Assalamualaikum warahmatullah. My name is Abdullah bin Jaafar from Group 6. So for this assignment, we in group discuss about this and we choose company Genting Malaysia Berhad. So for this assignment, we have include 7 parts, which is first introduction, liquidity ratio, probability ratio, efficiency ratio, leverage ratio, potential investor and supplies, and last but not least, conclusion. So, this is our group members. First, we have Nurul Izzah, Amira Nazira, Nurul Aisyah, Abdullah, which is me, and Ahmad Azad. So, for introduction, we will talk about Genting Malaysia Berhad. Genting Malaysia Berhad is a big company. Who doesn't know about it? So, first, we will talk. Genting Malaysia Berhad is a reputable leisure and hotel company. Genting Malaysia is a part of one Asia best managed multinational, which is the Genting Group. Who doesn't know the leads of the Genting Group, which is Tan Sri Lim Kok Teh. Genting Malaysia has a market capitalization of 15 million as of 31 December 2020. Genting Malaysia owns and operates Resort World Genting in Malaysia, Resort World Kijal in Terengganu, and Resort World Langkawi in Langkawi Island.
Assalamualaikum. My name is Amira Nazira binti Amir Rusdi. I will be present about the liquidity ratio of this company. Before I get into the calculation of liquidity ratio, I will tell first what is liquidity ratio. Liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligations. The metric helps determine if a company can use its current or liquid asset to cover its current liability. There are two main types of liquidity ratio, which are current ratio and quick ratio. Current ratio, this ratio measures the financial strength of the company. Generally, 2:1 ratio is treated as the ideal ratio, but it depends on industry to industry. The formula of current ratio is current asset divided by current liability, where current asset consists of stock, debtor, cash and bank receivable, loan and advance, and other current assets. Current liability consists of creditor, short-term loan, bank overdraft, outstanding expenses, and other current liability. And next, quick ratio. This ratio is the best measure of liquidity in the company. This ratio is more conservative than the current ratio. The quick asset is computed by adjusting current asset to eliminate those assets which are not in cash. Generally, 1:1 is treated as an ideal ratio. Formula of the quick ratio is quick asset divided by current liability, where quick asset equals to current assets minus inventory minus prepayment. Okay, now let's look at the calculation of liquidity ratio for year 2015, where the current ratio is equals to 2.3 to 1 ratio. The current asset is 8,541.3 million divided by current liabilities 3,666.6 million. We can interpret that for every 1 ringgit of current liability, the company has 2 ringgit 30 cents of current asset to repay the current liability. and the quick ratio is equals to 2.2 to 1 ratio, where the current assets is 8,541.3 million minus inventory 119.8 million minus 312.9 million of prepayment divided by current liability 3,666.6 million. We can interpret the quick ratio for every 1 ringgit of current liability. The company has 2 ringgit 20 cents of current assets to repay the current liability. Okay, next is liquidity ratio for year 2020. The current ratio is equals to 1.3 to 1 ratio. The current asset is 3,964.6 million divided by current liability, the 2,977.7 million. We can interpret the current ratio for every 1 ringgit of current liability. The company has 1 ringgit 30 cents of current asset to repay the current liability, and the quick ratio is equals to 1.2 to 1 ratio for that year. That the current assets is 3,964.6 million minus inventory 121.4 million minus prepayment 217 million divided current liabilities 2,977.7 million. We can interpret that quick ratio for every 1 ringgit of current liability. The company has 1 ringgit 20 cents of its liquid asset to repay the current liability. So now what you can analyze from the liability ratio, that company's current ratio for 2015 equals to 2.3 times. That's greater than current ratio for 2020 equals to 1.3 times. So the company's current liabilities for year 2015 are covered by current asset appears to be sufficient. 2015 has a high degree of liquidity with the ability to cover its current liability for the company rather than 2020. And also to the quick ratio of 2015, where it's equals to 2.2 times, that greater than quick ratio for 2020, which is equals to 1.2 times. As we can conclude that as the current ratio and quick ratio increase, the company's liquidity also increase. If necessary, more assets can be quickly changed into cash. Degree of liquidity for the company from 2000 to 2020 to cover its current liability can be shown that was decreasing. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Izzah binti Ms. Rosman, and I'm going to explain further in profitability ratio for the year ended 2015 and 2020 and give analysis about the profitability ratio. The first element in profitability ratio for the year ended 2015 is net profit margin. To obtain net profit margin, we have to divide between net profit and net sales and times it with 100 to get the percentage. For the year 2015, Genting Malaysia obtained 14.8% of net profit margin. That means for every 1 ringgit of sales, the company is able to generate 15 cent net profit. Meanwhile, for the gross profit margin, to obtain the gross profit margin, we have to divide between the gross profit and net sales and times with 100 to get the percentage. The percentage of gross profit margin for Genting Malaysia in 2015 is 24.3%. That indicates that for every RM1 of sales, Genting Malaysia is able to generate 24 cents of gross profit. Moving on, the next element in profitability ratio is return on assets. To obtain return on assets, the formula is to divide between net profit and total assets and times with 100 to get the percentage. And the return on assets for Genting Malaysia for the year 2015 is 4.5%, and that means the company earns 5 cents for every RM1 of assets. Next, another element of profitability ratio is returns on capital employed. The formula to obtain returns on capital employed is by dividing earnings before interest and tax with capital employed and times with 100. To obtain capital employed, we have to minus between total asset and current liabilities. And thus, the percentage of returns on capital employed is 6.6% for the year 2015. That means for every RM1 of capital used, Genting Malaysia is able to generate 7 cents operating profit. I'm done with 2015 and now I'm moving on to 2020. Back to the first element of profitability ratio, which is net profit margin. The same formula used to obtain net profit margin, which is by dividing net profit or loss with net sales and times with 100 to get the percentage. For the year 2020, it shows that the net profit margin is negative 52%. That indicates that for every RM1 of sales, Genting Malaysia generates 52 cents net loss. Next, gross profit margin. To obtain the gross profit margin, we have to divide between gross profit or loss with net sales and times with 100 to get the percentage. Thus, the percentage of gross profit margin is negative 2.2%. This shows that for every RM1 of sales, Genting Malaysia is generating 2 cents of gross loss. Next, return on assets. It is observed that the return on assets for Genting Malaysia for the year ended 2020 is negative 8.4%. This indicates that Genting Malaysia lost 8 cents for every RM1 of assets. Last but not least, return on capital employed. The results shows that for every RM1 of the capital used, Genting Malaysia generates 6 cents operating loss. So, what are the analyses behind all of these 4 elements that we have seen earlier? The net profit margin and gross profit margin for the year 2015 is way higher than the ones in 2020. Why? This is because loss incurred in 2020 caused by the COVID-19 outbreak, which drives to temporary closure of the group's resort operations globally. Same goes to the return on assets and return on capital employed. Both elements in 2015 are way higher than 2020. For the return on assets, the firm is experiencing a loss on the assets it possessed in 2020. That is why it indicates negative value. This happens when the company is unable to efficiently utilize its assets to produce income. Last but not least, for the element of return on capital employed, why 2020 is experiencing negative return on capital employed. Net operating loss is implied by a negative return on capital employed. The corporation used its capital employed more efficiently in 2015 compared to the year 2020. That's all from me. Thank you.
Assalamualaikum Assalamualaikum, my name is Nurul Aisyah binti Nurilimi. Now I will explain about efficiency ratio, which it is known as activity ratio in the financial ratio. This ratio will be used to know how well and how efficient the company or the firm is managing its current asset and its current liabilities. There are three types of efficiency ratios. First is the inventory or stock turnover ratio. Second, the average or debtor collection period, and lastly is the total asset turnover. Okay, the inventory turnover ratio is being used to know how many times that the stock were being sold and being replaced with the new stock within the accounting period. The formula for the inventory turnover ratio is equals to the cost of goods sold divided by the average of inventory. The average inventory is the summation of the opening inventory plus the closing inventory divided by 2. And next is the average or the debtor collection period. Average collection period is to calculate how many days that the company or the firm took to collect its debts from the debtors. The formula for the average collection period is equals to the account receivable divided by the annual credit sales multiplied with the 365 days. Okay, and lastly is the total asset turnover. Total asset turnover is used to evaluate the efficiency of the company, use its assets to derive their sales. Okay, this ratio, this total asset turnover will be used to evaluate the performance of the company within their competitors and their past performance also. Okay, the formula for the total asset turnover equals to net sales divided by the average of total asset. The average of the total asset is the summation of the non-current asset and the current asset divided by 2. Okay. Next, we will continue with the efficiency ratio for the year 2015 of Genting Malaysia Berhad. Okay. First is the inventory turnover ratio. Okay, based on the statement of financial position and the statement of profit or loss of Genting Malaysia Berhad in year 2015, the cost of goods sold is the 6,353.5 million divided with the average inventory, which is 110.05 million. So the number of times is equals to 58 of times. Okay, this for the inventory turnover ratio, we can state that within 1 year the company has replaced its average inventory with 58 times. Okay, next is the average collection period, where the account receivable is equals to 1,242.8 million divided with the annual credit sales is 8,335.9 million and multiplied with 365 days. So the total so it's equals to 54 days. Okay, the interpretation we can say for the average collection period is the company is able to collect its debts average within 54 days of the 1 year accounting period from the date of it making its sales. Okay, next is the total asset turnover, which is equals to net sales divided with the average total asset. Okay, the net sales for Genting Malaysia Berhad in year 2015 is 8,395.9 million divided with the average total asset, which equals to 24,159. So the equal is it will be equals to 0.35 times. Okay, the interpretation for the total asset turnover, for every 1 ringgit of average total asset, the company can generate 0.35 of net sales. Now let's continue with the efficiency ratio for the year 2020. Okay, the inventory turnover ratio for year 2020 is the cost of goods sold is equals to 4,269.8 million divided with the average inventory, which is 122.35 million. So it will be equals to 38 times. So within 1 year, the company has replaced its average inventory 38 times. Okay, next is the average collection period, where the account receivable is equals to 563.5 million divided with the annual credit sales, which is 4,528.8 million, and multiplied with 365 days. So it will be equals to 45 days, where the company is able to collect its debts average within 45 days of the 1 year accounting period from the day it making its sales. Lastly is the total asset turnover, where the net sales is equals to 4,528.8 million divided with the 30,799.9 million, and it will be equals to 0.15 times. For every 1 ringgit of average total asset, the company able to generate 0.15 net sales. Okay. Lastly is the efficiency ratio analysis. Based on the inventory turnover ratio of year 2020, which is 38 times, it has a low inventory rate compared to the inventory turnover ratio of year 2015, which is equals to 58 times. This could indicate that the inventory isn't moving because the company was overstocked. This usually might be a bad sign to the company because the product tends to deteriorate as they sit in the warehouse while incurring holding costs. Okay, furthermore, excess inventory will ties up the company cash and will be exposed to the market price drops. Okay, next is the average collection period, where the average collection period for 2020 is 45 days, which is much shorter than the collection period for 2015, which is equals to 54 days. The debt turnover ratio in 2020 is 8.04 times higher than it was in 2015. This could indicate that the company is converting credit sales to cash more quickly, and it usually be a good sign for the company's credit sales management because the debtors able to settle their debts more quickly. Okay, and lastly is the total asset turnover, where the total asset turnover in 2020 is equals to 0.15 times compared to the total asset turnover in 2015, which is equals to 0.35 times. Okay, this could indicate that the company is not making the best use of its asset in making its revenue. So this might be a bad sign for the company because it has a poor inventory management or excess of production capacity. So that's all from me. Thank you.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Ahmad Amir Aizat bin Ahmad Basri, and today I will present about the final part of the financial ratios, which is leverage ratio. Leverage ratio is used to determine the amount of debt of the company has taken on their assets or equity of their business. Leverage ratio for year 2015 of Genting Malaysia Berhad. Debt ratio. Debt ratio is defined as an expression of the relationship between a company's total debt and its asset. We can calculate the debt ratio by using the formula total liabilities divided by total assets times 100%, and the answer that we get is 30.57%. which means that the assets of the company were financed by debt 30.57%. Next, debt to equity ratio. Debt to equity ratio measure the riskiness of a company financial structure by comparing its total debts to its equity. We can calculate the debt to equity ratio by using a formula: total liabilities divided by shareholders' equity times 100%. And the answer that we get is 44.10%, which means that contribution of creditors is only 44.10% from the contribution of the investor. Next, time interest earned, also known as interest coverage ratio. Time interest earned measures the proportionate amount of income that can be used to cover interest expense in the future. We can calculate the time interest earned by using the formula: expense before interest and tax divided by interest expense, and the answer that we get is 16 times. The interest payment ability of the company against the debt it owes is 16 times. Leverage ratio for year 2020 of Genting Malaysia Berhad. Debt ratio. By using the same formula, we get the answer of 48.74%, which means that the assets were financed by debt 48.74%. Next, debt to equity ratio. By using the same formula, we get the answer 92.45%, which means that the contribution of creditors is 92.45% from the contribution of the investor. Next, time interest earned. By using the same formula, we get the answer 15 times, which means that the interest payment ability of the company against the debt it owes is 15 times. Analysis of leverage ratio for both year of Genting Malaysia Berhad. Debt ratio for 2015 and 2020 are 30.57% and 48.74% respectively. It indicates that a larger part of Genting Malaysia Berhad's assets is financed by equity, not loan, for both years. This shows a great sign for Genting Malaysia Berhad because its debt ratios are still lower than 50%, and it is considered as a very low risk company. Next, debt to equity ratio for 2015 and 2020 are 44.10% and 92.45% respectively. For 2015, it indicates that there are almost half as many liabilities than there is equity. For 2020, its debt to equity ratio is almost 100%, which means that the investors and the creditors have an almost equal stake in the business assets. Next, time interest earned for 2015 and 2020 are 16 times and 15 times respectively. Genting Malaysia Berhad's income is 16 times and 15 times higher than its interest expenses for the year 2015 and 2020 respectively. Creditors would favor a company with a much higher time interest earned. Now I would like to answer a question from the task given. The question is, as a potential investor and supplier, would you like to have a business relation with the chosen company? In this case, the chosen company is Genting Malaysia Berhad. Based on our finding for 2015, all of the financial ratios, including the liquidity, profitability, efficiency, and leverage ratios of the company, showed an extremely strong financial management and very low investment risk. However, for 2020, unfortunately, the COVID-19 outbreak caused a major decline in the company's performance. But for us, as an investor, we must forecast the business future. So what we see is the business can still avoid bankruptcy and continue to operate well until today. So this demonstrates how powerful and appealing Genting Malaysia Berhad is as corporation. And to answer this question, as a potential investor and supplier, we will agree to collaborate with Genting Malaysia Berhad, and it is a tremendous opportunity for us given their experiences going through a lot of difficulty, and we have faith in their knowledge and past experiences that the company can endure whatever the difficulties arise in the future.
Assalamualaikum, it's me again, Abdullah. So, for the last part in this present, which is the conclusion, we can say that applying the accounting concept in the business essentially is provide quantitative information of the overview of the business performance, which is very important in the company. After comparing for 2 years, which is year 2015 and 2020, for Genting Malaysia Berhad financial statement, we can say that liquidity, profitability and efficiency ratio in year 2050 indicates better performance than year 2020, because the ratio in the 2050 higher than year 2020. Leverage ratio in year 2050 is less than leverage ratio in 2020. Company less depend with a money owned, which is borrow from others. So, last, we hope that Genting Malaysia Berhad should take initial method in keeping the company more relevant and effective in the future, which is very important for the company.